Happy Tuesday. Today's date, January 27th. We welcome all of you here today and good morning. Now, just real quick as we get started, today is going to be really part two of our caller discussion. I'll show you that link that we did before. So if you did not see that, you want to see that, as today will make more sense. Now, we're going to be very specific with what we talk about because we've been looking forward to it. So let's get to it. Now, just real quick, remember we do post educational content on X. There's my handle there. Also, quick reminder that with what we discuss here today, we'll talk about options. We're going to talk now. The strategy that we're going to talk about is called a caller strategy, which is buying the stock. Could be even an ETF, okay? But our focus will be a stock. And also, we'll talk about using options with that stock. Now, also remember the information here is provided for general informational purposes only. And as we talk about options, remember that you don't have to do options. It's something you might consider and maybe do or not do. You get to decide. Also remember when we talk about examples, we will do those examples on the paper money software application. Also remember that investing involves risk, including loss of principal. And really the focus of this strategy is to learn to define risk as a stock investor for a certain period of time, known as till expiration. And also remember with what we talk about here today, if we talk about, selling a call like we do on a caller, that can be assigned up to expiration regardless of the in-the-money amount. So that's always the risk. That doesn't necessarily mean it's bad though, per se, because that would actually be a cap gain strategy. Okay, so in this strategy, I want to point that out. That might not be the worst thing. Have to consider your own situation. Now, as we get started here today, we're going to have three things specifically that we want to talk about. I'm going to take a quick look at the market, just like 2 minutes or less, just fast fire. Then what we actually talk about from there is we're going to talk about the timing of callers in terms of legging in. Setting up the caller legging in is something we did not talk about before, but I want to actually include. And then what we're going to do is talk about the management of callers, the sample rule set that we discussed historically, but I want to talk about with examples. And then we're going to talk about some new examples going over earnings. Now, you might be thinking, well, why would I even do a caller? Well, if you're actually trading stock already and you've actually had some losses before in your life, well, you might want to consider it, okay? At least consider it, especially where we're around earnings and where things can be a little bit more volatile. Now, super quick actually on the market, what do we got here? So if I move over just real quick, kind of go up. First thing when we actually take a look at, let's say if we talk about prices, crude oil, okay, we talked about the energy sector. Crude oil has been grinding back to the upside, okay? Now, it's not moving like the other commodities, but it's at least healing from when it was at 55. The Swiss franc, okay, overnight, okay, talked about this on Friday, talked about it yesterday. That US dollar taking another push down here. And good thing when I taught the futures class, we talked about currencies. That's not a new low for the US dollar, but it's daggum close. Remember, one way actually be bullish, let's say, or go the opposite of the US dollar is commodities. Okay, it's not the only way, clearly. Commodities could be gold, it could be silver, it could even be currencies in general. Now, also what you're now going to notice is if I go to the Canadian dollar, our Canadian friends, and what you're now going to notice is that's not a brand new high, but that looks like a longer term consolidation potential continuation pattern. The Australian dollar, as those have been watching the Australian Open, those Aussies enjoying that Aussie dollar relative to the US dollar. The euro, man, if you're looking to go to Europe, it's gotten a little bit more expensive. The Japanese yen is also appreciated relative to the US dollar. The British pound is actually almost at a brand new high, 138 relative to the US dollar, meaning you got to give $1.38 for one of their British pounds. So here we are seeing the US dollar, you could almost say sink relative to the other basket of currencies. Now remember, if you're seeing the US dollar like cash sinking relative to others, people might say, is there any place I could put that US dollar that might appreciate, not depreciate? Well, speaking of that, if we actually go down to the S&P 500, remember we talked about the gap down, the resistance level there? Well, we got above it. Remember we actually talked about where we gapped down from? Yesterday we actually closed above it. investors are fleeing that US dollar, okay, and trying to be in something that could appreciate, not depreciate. So people say, why are people buying actually, let's say, equities? Because they want to get in something or try to have the chance, maybe better to go up or hold value than the US dollar, okay? I mean, do you enjoy your dollars going down to other things and maybe or inflation? Maybe not. That's why people are focused on it. Now, if we take a look at, let's say, the Dow Jones is not getting help here today from United Healthcare that was down a lot, okay? I don't know how bad it was. It was pretty bad. How bad? 19% bad, okay? Earnings for them, not good. Dragging the Dow down. The surprise, well, I can't say the surprise because we've talked about it for 2 weeks. The one question we ask is, could the NASDAQ finally play a little catch up? NASDAQ actually did not break out and hold. It broke down, snapped back to the upside. That breakout that we were looking at for about 2 weeks ago, finally actually starting to get a push. This is a shorter term higher high on the NASDAQ. And of course, if we're saying NASDAQ, we would actually be saying things like, for example, like SOX. And if you look at, let's say, SOX, of course, this would be, let's say, Micron, NVIDIA. It could also include STX, the memory chips, WDC, STX, and so on, among others, okay? Now, it's kind of interesting to note this. The one other thing we got to have to pull out just real quick, of course, is the transportation stocks. Remember, the transportation stocks, I just want to kind of note this. If you look at UPS and FedEx, they actually look pretty strong, okay? If those are actually strong, it's kind of leading us to think that maybe the economy is not as weak as we probably would have thought of or people have said. And if you actually go to the discretionaries just real quick, keep an eye on, let's say, stocks like Amazon, Apple that have actually gotten a pretty good pushback, okay? Now, those are some of the, now don't worry, we're going to circle back around and we're going to do some example trades, okay? Now, I want to talk about just real quick the timing of those collars, okay? Now, Bill Bornhoff, he calls this 7 steps to avoid gain and Bill, I can't even spell this, antiquity. Did I spell that right? Now, what is antiquity? Okay. It's really like, have you ever had profits or unrealized gains? And then you just said, James, I completely gave it all back. Now, all of us here have done that. Okay. Don't feel like you're the only one. Now, what I'm talking about right here is we're talking about legging in. And this actually means that the investor has the stock already and later on applies the collar. And what does that mean? They sell the call and buy the put. Okay. Now, let me actually move that there, give us a little room, and let's go to work. Okay. Now, before when we talk about collar, we did not talk about legging in. I first learned actually a collar, not as far as a buy, right, protect strategy, but legging in. First buying the shares itself, and then seeing some of these situations play out. What are the situations that we're talking about? Why are we talking about this first before we talk about management? Well, because if your entry is better, the management is probably going to be maybe a little easier to consider, okay? So right here, when we talk about 1, 2, 3, this is where the stock has risen, okay? This actually means that there's unrealized gains on stock. Now that, I mean, if you kind of said, where would you like to be? Many investors would say, geez, that's where I'd like to be. The stock has risen, and there's unrealized gains on the stock. Now there's actually something to protect, not only the capital to buy the shares itself, but actually, in this case, that there's unrealized gains. So number one is, and I'm going to give examples, okay? So number one, when we actually talk about this, what do we mean by number one? Number one is when we have parabolic, okay? Parabolic price action. Now, what is a tool to help us see parabolic price action? Well, the tool we actually use is the EMA envelope, or the moving average envelope, okay? And you know exactly what I'm talking about, okay? So that moving average envelope, That's actually where we, if we go to this tool right here, we go to that chart package. Let's go to this right here. When we talk about the explosion of price action, let's pull up the example. Let's go to on, okay? So remember when we kind of talk about when we see the stock go to the upper white line, this is when the stock, what is the white line? Type it in the chat. What is the white line? The white line is really represents what percent off the moving average, namely the 10-period moving average. That white line really represents 7% above the 10-period moving average, which is in blue. The higher you go above that, the greater the chance you could pull back down to support, because investors say what you do. I don't want to buy until we're closer to support. So if someone is trying to like put on a collar, they might say, James, when I see the stock go above that white line, I want to actually put on a collar. I already have the shares already, but I want to put on a collar. And a lot of times what can tend to happen? Well, you kind of consolidate back down. Then the stock actually goes to the white line. What does the investor might say? Geez, I might put on a collar. It did that there, it did that there, and what did it do? It kind of consolidated. Notice what actually just happened the other day again. It goes above the white line, and then what does it do? It kind of pulls back. So it pops and fades. So when we actually say, let's say, number one, parabolic price action, we're really talking about, let's say, the price, okay, 7% above 10-day EMA. That's what we mean by that, okay? So now here's the thing. You could say that. It doesn't matter if you can't recognize it. So if you don't have that moving average tool, let me just send that to you. I'm just going to send you this right here. And I think actually that's a very simplistic way to kind of really see when have things got maybe a little hot. When could they consolidate a little bit? Now, when we talk, now the biggest thing we need to understand is about 1 through 3. 1 through 3 is really, we're talking about resistance. So the price is up near resistance areas. Okay, now stop for just a second. Is resistance all the same? No, it's not. Okay. Now, if we actually said, let's say, now, if the price did parabolic price action, there's potential resistance and there's maybe more resistance. When we actually say, let's say, number 2, we're really talking about more what you'd probably be thinking, diagonal horizontal resistance. Okay. And that's kind of more classic. I think more people say, yeah, I get that. Okay. But just because we have parabolic price action, that doesn't necessarily mean that we're not in an area of potential resistance. And the third one, real quick, is really stocks at a Fibonacci extension level, like the 161 extension, like the 200% extension, like the 261 extension, all the above. Let's see examples. So I'm going to write right here, as you're studying this out in your mind, I'm going to write right here the example of this parabolic price action I gave was on. I'll put $ON. If we talk about diagonal resistance, I would actually look at example given of AMG. I'd also look at examples of Chevron, okay? I'd also look at, for example, like stocks like AU, which is the gold stock. I'll show those in a moment. And if I said, give me an example of something that had an extension deep into that extension just recently, the ticker is NU. So I want to talk about what we're talking about. I want to talk about the tool of it and the example of it. So give me an example of what you really mean by horizontal diagonal resistance and extension. Super quick. Well, if we looked at, let's say this, an example of something that actually has gone pretty far to the upside, we'll go back to Amgen. And if you look at what we mean by that, just a stock that kind of went up to an area of resistance. Classic. It's also a stock that went up to an area of resistance, but it also, for example, has upcoming earnings, like many stocks. Okay, Chevron, it's very similar. Chevron, kind of right back up near this area of resistance. These tend to be areas where investors say, look, I may be anticipating some investors selling. Number one, they're trying to protect their unrealized gains and their capital. But the other thing is they're saying, look, I want to go over earnings with a defined risk where they buy the put, where there's a right to sell the shares at that strike price. Now, if we kind of looked at, let's say, this other one, AU is an example of more of like a diagonal line of resistance, which is more signifying an upward trend. Okay, so it doesn't always have to be horizontal. Now, if we looked at this last one and said, give me an example of something that went to an extension target, example given of NUE, something that went within 1% of an extension target and then actually fell down. So all of the above. Now, as investors, we always want it to be, just give me one thing. Give me one thing. Look, life ain't always about one thing. We're going to have to think, okay? So when we talk about 1, 2, 3, we're talking about stocks that have gone to areas of resistance. Are resistance all the same? Say no, they're not. Resistance, potential resistance could be parabolic price action. Potential resistance could be a Fibonacci extension. Resistance, probably more defined, probably more typical of what we were thinking about, would be diagonal horizontal resistance. And I gave you actually ticker symbols. You could actually go back to review that. Now, super quick. Now, when we talk about 4, 5, 6, and 7, this is where the stock has started to fall. Now, wait. If the stock has started to fall, what does that mean in terms of your unrealized gains? Or what does it mean in terms of your capital where you bought the shares of the stock? Well, if we're going 4, 5, 6, 7, remember 4, the difference between 4 and 7 is how far the stock has slid. Okay? So 4 is where the stock closes below higher low. Now, how would you be able to see that higher low? Answer. Well, it's going to be the Cahole dot. Okay? It's going to be the Cahole dot because that higher low is also where we actually had that orange-green color candlestick. I'm just going to write this out. Stock falls or closes, okay, below diagonal horizontal support. Okay. Now, if we actually put this right there, if that stock closes below diagonal support, what does that tell us? Well, that's a lower low in the short term. What is the visual tool, okay, for seeing that? Well, the visual tool for seeing that is your 10-day EMA. So that's how you're able to identify, hey, this trend is maybe starting to drop a little bit. Now, if we look at this next one, the 6, the 10-day EMA is below the 30-day SMA. We're talking about a cross down. So if you actually say, okay, now I'm going to put on the collar. Now I'm going to do it. My gosh, the farther that you wait, so if the stock actually goes below the higher low, well, that's the first sign of making a lower low. If then you wait for that stock to actually then break the diagonal horizontal support, the price typically has fallen further. The price has fallen further. The stock is actually, your capital is getting pushed down and your unrealized gains are shrinking. So you're getting later and later in terms of putting the protection on, which means you're actually holding the stock. The other thing is if you say, I'm going to wait further, well, the 10-day moving average is below the 30-day SMA. It's crossed down, signifying further sell-off. And the last but not least is what we call triple whammy. I mean, you've looked for, in this case, a lower low, okay? You got a lower low. You've actually had a moving average crossover. Moving average let me actually say a lower low, a broken support, and a crossover, okay? So if you find, so what you want to do is you want to say, look, James, I practiced legging into a position, and you want to ask yourself, where are you putting on the protection? If you go back and say, James, the date that I put on protection was predominantly 6 and 7, then I don't think you see a lot of value in callers. Because by the time you recognize that you put on callers, you're late. You're late, okay? And by the time you put on callers, that stock might be at the point of where it might have fallen already and now be starting to reverse. And so all of a sudden you finally put on the collar only to see the stock finally start to go back up. And now you feel like you're always a day late and $1 short. All right. Now, obviously, when we talk about in this case, Okay, we're going to spend the rest of the time on the examples of management and the new examples. Obviously, this would just be a moving average cross on the chart, okay, which shouldn't be that hard to see, or it could actually be on the Market Watch quote page, which shouldn't be that hard to see. Can't say it's too hard to see. Can't do that. Now, the big actually thing is if we went back on this and said, how could we actually see the lower low broken support crossover? The same thing here. All this is really going to be showing is the moving averages, okay? The number of days red increasing. This is not day 1, day 2, day 3. You're probably day 5, 6, 7 into the sell-off. And we've talked about quite a bit about that, okay? Now, first off, what is the takeaway from this? Why do we spend the time talking about this? Well, because if your timing is not great, we're gonna probably speculate that your management of the collar is gonna be off, okay? Now, can you say that every time you put your collar on in the prime time? Not necessarily, because not every time the stock it's not always going to go to a parabolic level. It's not always going to go to diagonal horizontal resistance. It's not always going to go to the Fibonacci extension. But if you had to actually put a grade on, if you did 1, 2, and 3, you put it on prime time, okay? Think of that as A, okay? Now, why might the investor not just sell it? They're trying to build positions over time. They're not trying to actually have their whole portfolio as a trading portfolio. 4, we would actually really be like, we would say is more of a B, okay? I mean, you waited for the price to show some signs of weakness. This is the first sign that it's really starting to drop. If you actually wait for the stock to drop below the diagonal horizontal support, that's going to be kind of more what we call that purple color candle. If you get the cross down, it's what the candles should show, 6 and 7. Just where the sellers are becoming more in control and pushing the price down. So from this, when you practice collars, ask yourself, where are you putting on the collar? That makes sense? This is how you grade yourself. Okay? You can't always do 1, 2, and 3, because sometimes they don't go there. But if you're always putting on your collar in step 6 and 7, you tend to be late. Okay? Now, any questions with that? Now, the comment is leg in with a short call at trend 4 and put a put on trend 5. Maybe. No. Okay? When we talk about legging in, we're talking about putting on the short call and the long put together. Okay? So if we see the stock close below the higher low, what was the ticker symbol of that example? Let me give it to you. BMY. Let me see what that looks like. BMY on the chart, before we actually look at the management examples here with kind of rule set and examples. What we mean by this is if we see the stock, for example, where it goes up like this, right there, I want to actually pull that back. So the red and green candle. Let me go to actually this chart. The easiest way to really see, okay, the easiest way to really see that red and green candle. So let's say we're right here. And we say, James, I have a position on Bristol Myers, and I have a red and green candle. Now, don't overthink this, okay? The red candle is where the stock has stopped going down, and the green candle is where the stock starts going back up. That is where we have a higher low. Now, if we go lower than that level, that's not a higher low. That's a lower low. That's a sign of weakness at that moment in time. We go forward to the very next day. What does it do? Trades below there, doesn't close there, but the very next day, what you're now going to see is it does close down there below the higher low. This would be step 4 of what we talked about. Stock closes below the higher low. Okay? That's what we mean by that. So if we saw that, what would the investor be doing? Selling call only? No. Okay, in our example, selling the call and buying the put. All right? Now, let's look at some examples. Now, when we talk about the management, we talk about 4 scenarios that we actually see predominantly. 4, okay? 4 scenarios, not 44, 4. And the four scenarios is we have bullish, okay? We have bullish, we actually have bearish, and we have flat. Now, when you go back and put these on, based upon the specifications that Bill and I talked about, it really comes down to when you back test bullish, and I'm going to label this after 9 to 10 trading days. Now, the significance of the 9 or 10 trading days is you want to be able to define resistance. Resistance is not formed in 1 or 2 days, okay? So when I say bullish, what do you mean by that? Meaning you put on the collar and the stock has gone up, okay? Same thing here. You put on the collar and before 9 or 10 trading days. Now, let me kind of read to you kind of what we've talked about before, okay? So you decide you're up at an area of resistance, okay? Example given. And you decide that I'm going to collar the position. Now, listen to what we're saying, okay? The stock pulls back and then breaks up through resistance. Could be diagonal or horizontal. After 9 or 10 trading days. Define the resistance and then set a buyback for the short call 1 to 2% above resistance. Okay, now what I want to do is let's kind of take that to what I said and let's look at as far as an example, GM. Now, if we look at an example given GM, let's say on this stock, we can see an area of resistance. Now, what you're also going to notice is on this chart is the moving averages. We kind of see that there's red moving averages, and this represents where the investor might have said, hey, I'm going to put on protection. Is everyone with me? So you're in a stock position. You decide on the right-hand side, I'm going to leg into a collar. I'm going to sell the call and buy the put. Protect the stock position. And now the investor says, well, of the four scenarios, how am I going to trade the position? Now, on the first situation, after 9 or 10 trading days. So what this really means is whatever happens on the right-hand side, it doesn't matter. They're going to trade to the 9 or 10 trading days. They're going to allow time to pass to see if that resistance is still intact. Now, remember, when they put on the collar, there's a max gain, there's a max loss built in. Okay? Now, let's go forward here. Let's count. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now, here's what happens. Here's what happens. Yeah, but James, 5 days later, it pops to the upside. The collar is a bearish position. That's not true. If that stock actually breaks to the upside, okay, it just means that we're getting more and more and more of the maximum gain. So that's not horrible, but we're not uncapped, meaning we still have the obligation to sell the shares of the call. In situation number one, if we put on the collar here, it doesn't matter what happens in the next 9 or 10 trading days, because the investor is actually thinking that where they put the collar on is in the area of resistance. We know that within the area of resistance, sometimes the stock can go above, but then fall back down. So if someone's trading that number one scenario, they're really trading to maximum gain. Okay? Now, they did something right there, took the call off. What actually happened the very next couple of days, it fell right back down. Let's go forward here. So now all of a sudden, we now define resistance. If we define resistance, we're saying, look, we're going to set a buyback for the call, setting a buyback, okay? Setting a buyback for the call, for the short call. And we're going to put that, we're going to take the resistance times 1.01 or 1.02. What is that? Well, what that really is it's 1 to 2% above the resistance. Now, why the call? Does anybody know? Why the call? Well, because that's the cap. If you actually said what side of the trade, the short call or the long put probably has a bigger negative delta, it's probably the short call. The longer it takes for the stock to break out, you're actually going to see in this case that the long put is probably not worth a whole lot. So you could say I'm going to get out of it, but how much are you really going to get out of? And that is really, that long put is your right to sell the shares. So in that first scenario, you're really saying, look, I'm going to put on the collar. I don't care what happens in the next 9 or 10 trading days. And if that stock actually breaks to the upside, I'm not doing anything. I'm trading to the maximum gain. But wonder if the stock shoots to the upside and you got 85% of the maximum gain in 10 days. Well, you're trading to the maximum gain. You're trading to the rules that we talked about before. If you can get 50% of the max gain in 10 days, that's a really good gain. You get 65% of the max gain with more than 20 days left, that's a really good gain. If you get 80% ever, that's a really good gain. And when we talk about taking those gains, we're not talking about, let's say, rolling the options. We're talking about getting out of the entire collar completely. That means the shares too. Meaning you're grabbing the maximum, near max gain. Now, if you look at this and kind of say, well, what happened? Well, we follow forward, and now what you're going to see is the stock actually went down, and it's a good thing you kind of held to your guns here. Because what happened is it went down, then it went over earnings, and now let's talk about this earnings. Well, when we have earnings, how long do we want to wait to consider until we touch the collar? The answer is 3 trading days, okay? So if this stock pops up like it did, the investor might say, look, I'm not going to buy it back today, especially if we knew we had earnings. I'm going to wait 3 full trading days. Why? You ever seen something pop up after the earnings and then push right back down? The investor is using that long put to define the risk. So on this, we could actually say, look, if we went above resistance, 83.28, add one, let's say 1 or 2%, I'll even say 2. That buyback is really at 84.94, but you can make it specified or timestamp it. Buy it back if we're above 84.94 on 3 trading days after the earnings. Okay, now what if you didn't have earnings? Well, what would have happened to the position? Highly likely, the investor in this case would have had the call bought back. When the call is bought back, let's show what this looks like, okay? Why are people so fanatical about, for example, buying the call back? Well, it's pretty simple, okay? If I went back to a stock like ON, and what I'm going to do is, in this case, I'm going to go to the trade tab just real quick. Go to the trade tab. We're going to kind of show this position. As we're on it, let's kind of show, well, I can't do that because the options are a little wider. Let me go to CSX just real quick, CSX. Now, if we take a look at this, if we buy the shares of stock, click on the ask price, okay? We're going to buy the shares. And now what I'm going to do is go first, single order, first triggers SEQ, click on that bid price. On that bid, we're going to want to make sure we try to get somewhere, let's say, in the middle here. That middle is really about 70 cents. That's the 38, okay? Now, if I looked at that, just this example, and then let's say we buy the put, I'm just going to show you what this looks like. The put on this side is probably going to be about the 36.5. If I put it on just together, let's say the 38 and the 36.5, we could also just say sell collar. We've done that before, okay? The 38 and the 36.5, okay? Now, what this really does in this case is when we do this, when we put this on the Analyze tab, what it's doing is it's really, okay, that right there is the stock position. That's why people like stocks. If it goes up, there's nothing capping the position. But if we actually, in this case, let's say, and so I can see this individually, let me just do this piece by piece. Selling the call, then buying the put. Let's put those on the Analyze tab. That right there, that's the cap, okay? And then obviously on the downside, we can actually see in this case, the put, there's the put. So in situation number 1 and 2, if that stock breaks to the upside and they do buy the call back on the diagram, it's going to what? Uncap the upside. Okay? Why 9 or 10 trading days? When you go back and back test what you're going to find out if your entry was good, what we talked about, and if you fiddled around with it in those first 9 or 10 trading days, you're probably going to see a high failure rate. This might be your first time seeing this. This ain't my first time seeing it. I've seen thousands of these. You think I'm kidding when I say thousands. I ain't kidding, okay? How long have I looked at callers? Since 2004. So for 20 years, okay, I've looked at callers. Now, that doesn't mean there's recommendation for everyone, but I've seen some examples. So the rule set that we actually talk about, there's reasons behind that. Now, the one thing is there are some people that say, yeah, but James, I put the collar on, and before 9 or 10 trading days, I saw the stock go to the upside. Well, let's read the language there. If we decided, hey, look, if I put on the collar and before 9 or 10 trading days, the stock breaks to the upside, now what? Well, let's kind of read what we actually talked about. Well, number one is you protected your stock position, meaning you put on a collar. The stock prior to 9 or 10 trading days, post applying protection, breaks to the upside. Number one, the investor might consider selling a put and or a vertical, whether it's a long call vertical or short put vertical. And what it's really doing is it's adding a bullish position to the trend, but it's not altering the collar. So that way, if you do take a chance to put on a bullish position, it's a bullish position that's not as bullish as, let's say, buying shares of stock. Example given. Now, this sometimes is going to happen. You have a stock position, NEM, and it's going to the upside, and all of a sudden, the stock drops through the floor. You put on your protection. Now, by the way, what step would this be? Would it be step 1, 2, 3? Or would this really be step number 4 and 5? Answer, 4 and 5. It got down below the higher low, and it also got down below the diagonal support. Do you see that there? If I drew a diagonal support, that diagonal support was there, and you had the higher low marker right around there. We got down below that. It was really step 4 and 5, which means you gave back some of those gains potentially on the stock. Now, if we look at this, we put on the protection. Let's count. 1, 2, 3, 4, 5, 6. Now, what are you thinking at this time? You're thinking, I hate a collar. I hate a collar. I got in the collar right there. I'm protected. Probably have a delta right around 30 to 40. And what does the blasted stock do? The stock goes to the upside. Now, is it buying the call back? No. Okay. Based on back testing that we've actually done over years, we're going to play the percentage gain on the collar itself. That stock actually breaks to the upside. You say, James, I see it being a bullish example. What are some options? Number one, cash secured put. Option number 2, short put vertical. Option number 3, long call vertical. Those are bullish strategies over on top of the position. So that way, if it goes to the upside, your position overall on that ticker symbol is increased. What happened? Well, the stock did go up. What about your collar position? It probably went near max gain or at max gain. What about the short put, long call vertical, or short cash secured put if you actually did that right there? They were both profitable. Now, is that always going to be the case? Of course not. Okay. Now, but that's the example. So the question really comes down to is if it breaks to the upside inside 9 or 10 trading days, are you willing to put on a strategy that's not as bullish as stock? That's if you wanted to. Okay. Now let's talk about that third situation, bearish. Okay. Let me kind of recap what we've talked about. The stock drops. Okay. So on a stock example given of Avgo. So let's say right here you said, hey, James, I put on bearish protection. The stock drops. And when the stock drops, what you got to remember in this case is the call becomes worth less and less. You're starting to have bigger and bigger losses on the unrealized gain, potentially, if you had some, on the shares. the long put starts to become more and more valuable, becomes in the money. And we talk about if that stock actually goes down, what can happen in this case is you can roll the long call probably about one time. Why is that? Well, because if this stock actually drops to the downside, so if we put on a call right here for December 5th, what was your expiration you probably picked? It was probably the third week in January. Why would the investor not buy that call back right here or tinker with that? You got earnings the next day. Does that make sense? That's why the investor would say, I'm not touching that. You got earnings the next day. What happens on the earnings? It gaps to the downside. When the stock gaps to the downside, the stock's underwater probably, or giving back profits. The call is decreased in value, the volatility is contracted, and has lesser chance to be in the money at expiration. But the put is increased in value because now we're closer and closer to the long put strike. Now, what you're now going to notice is this stock, let's go to kind of where we can see the expiration. If you look at this, the stock drops and it drops and it drops. If we went back and said, look, realistically, what call do you think you would have sold? Well, probably the 400, okay? What put do you probably think you probably would have looked at? Probably the 380, okay? So if we legged into a collar there as the stock broke down, the stock was below the long put strike. And it stayed below it, stayed below it, stayed below, stayed below, stayed below, stayed below. And you go all the way to expiration, what you're now going to see is why was the call never bought back? Or excuse me, in this case, the long put never changed. Because if your stock is below the long put strike price, that position is still underwater. You got to ask yourself the question. Would you want to, for example, have a right to sell the shares at 380? Or do you like to kind of have a speculative trade that the stock might go up to where you could already sell it for? So when the investor did this trade, they're probably selling the call out of the money, maybe 400. Buying the put below that stock price, probably the 380. When the stock came back up, it was still nowhere near where the long put is. Now, what did we say before? So in this case, if that, for example, if we're talking about on the week of expiration, if that stock is set to close below the long put strike, the investor could consider getting out of the entire position, meaning exit the collar, sell the shares. There was nowhere in here where we even got close to even that long put strike, which means what was the most profitable side of the position? The long put. We're not exercising the put. We're just selling the put for the intrinsic and extrinsic value. Buying the callback, which probably was rolled once because it could, and the shares that were probably underwater. Okay? So I want you to remember something that I don't probably say enough. If this bounce to the upside is not even above the long put strike, you might say, I want to see more upside movement before I get out of the long put, because the long put is the right to sell. Okay? And if you're not even getting above major resistance and or above the long put strike, be very careful about getting rid of the long put strike. Now, situation number 4, nothing happens. There's no break of resistance, there's no break of support. What happens in that case is the short call expires worthless, and so does the long put. And at that point, the investor could say, do I want to roll the collar, or do I just want to set up a stop on the stock? Now, what we talked about here, just real quick, is very important, because a lot of times, and this is kind of what we've said for years, 20 to be exact, if your entries are better, your management will could be a little bit better. 1 to 3 is what you hope to have happen. Doesn't always happen. But if we kind of said, now, why do we like to use the trend color candlesticks on the chart? Because the trend 4 and 5, which is trend 4 is orange, trend 5 is purple, if we're trying to put on the collar, that's when we're trying to put it on at the worst. If we wait until to put the collar on in 6 and 7 when the candles are red, we've had a deeper drawdown where we probably might not have any gains on the shares, and the collar is later. Now, you got to think about, once we put the collar on, what are those 4 scenarios that we verbally spoke about and showed examples of? Why did we talk about the collar here again? Well, because many investors might say, James, I'd like to buy a number of different tickers, but I'm concerned about so many stocks having earnings. Hello? This is one of the reasons why people like to use collars, okay? So I'm out of my time here today. Was today helpful talking about the 7 steps to avoid gain antiquity, Bill? Was it also helpful to walk through verbally and graphically examples of walking through the management of the collar? Now, over the years, these are the examples that we've seen playing out over and over and over. So we want to be made aware of these. I'm out of my time here today. I want to thank all of you here today. And also remember that, trust me, we'll see more collar examples over the year for sure, okay, as we practice. But this will give us the foundation. Now, remember, with what we discussed here today, it was done for example, illustrative purposes only. Remember that with what we discussed, it was done to demonstrate the strategy, okay? And the biggest thing is absolutely go back and rewatch it. Go back and let it sink in. And it took time for me to let it sink in as I practice it in the Paid Money account. Now remember, Cameron May is coming up next. This has been the class of part 2 of collars, the entry, the timing, and the management. With that said, thanks so much. Take care. Bye-bye.